I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Price to earnings ratio, or PE ratio. What is it and how is it used? The PE is used to get a quick valuation of a stock. It gives an investor an idea of how much premium they're paying for a company's earnings. This way, an investor knows if the market is currently pricing in a high or low premium for a stock. It is calculated by taking a company's price per share and dividing it by their earnings per share. It is also known as a stock multiple. The PE ratio can be calculated based on the trailing 12 months, future projected earnings, or through the Shiller PE method. Some investors will use it to gauge how many years it will take to make back their initial investment. The lower the PE, the less an investor is paying for a company's earnings. It can be used to compare companies within the same sector or industry. For example, you have two companies and they both make chairs. If company A has a share price of $50 and an EPS of 5, its PE ratio is 10. And if company B has a share price of $80 and an EPS of 10, its PE ratio is 8. This means company B might be a better investment because it represents greater value from a PE perspective. It's also important to note that a high or low PE does not tell the whole story. It's important to keep in mind a company's age, growth, and other factors that could impact the PE ratio. Each sector and industry will have a different PE ratio based on certain assumptions. For example, banks or utility companies might have lower PE ratios because they are not expected to grow by a lot each year. Tech stocks might be expected to grow at much higher rates and on average are traded at higher PE ratios. Here are a few ways the PE of a company could change based on the change on price and or earnings. For example, if a company has significant increase in earnings and the price remains unchanged, it could be a potential buying opportunity because the market has not yet priced in the earnings growth. It is important, however, to keep in mind that the PE can be affected if a company has had its shares diluted, and also traders will want to keep an eye on the historical average for the share price and the PE ratio. Some things to consider when looking at the PE ratio is to compare the PE of a company to its peers within a given sector, industry, maturity, and size. Also consider how it is trading compared to historical average. It should also be used along with other metrics and ratios when evaluating a potential investment in a particular company. If you found this information helpful and would like to see more videos like this or get notified when I release a new video, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see videos on a specific topic. Thank you for watching and have a great trading week.